Today's video, I want to talk stock market. We've had quite a bit of pain here, a lot of selling pressure over the last few days and few weeks. As you open up those statements and log into your brokerage accounts, all of us, we're starting to see the dollars really add up on the downside. So I wanted to do a video here, talk about the market environment, talk about why we've gotten here, also kind of put it in perspective and frame it for how we can look at this going forward and putting it into a longer term framework. And then finally, at the end of the video, I have a fun financial advisor tip and trick to try to turn some of these market lemons into lemonade. So make sure you stay tuned to the end of the video for that. If you haven't done so already, please like and subscribe to the channel below. Now let's get to it. So I think the market, what we've seen is a confluence of negative factors, a lot of headwinds that have kind of come together. So we have they call it a hawkish Fed. So increasing interest rates, reducing that monetary policy, the monetary stimulus by tightening, reducing their purchases or eliminating purchases of certain bonds and mortgage-backed securities. And again, obviously interest rates going up, increases the cost of debt. Whenever we're trying to expand our business or, maybe buy, as consumers we're buying certain things and putting it on credit. Well, when those interest rates go higher, the cost of that debt also goes higher. So that starts to kind of put a damper on some of the economic activity. So we have that going on. We have inflation, which is running at 40+ year highs. Does not look like it's abating. We had a couple reports this week. And then of course we have a war going on in Eastern Europe. So, who knows when that'll end. And I think you take all that together and you look at the valuations of the stock market and some of these companies that were such high flyers over the last year and a half, starting in the middle of 2020, the newly hot IPOs, the SPACs, all of these high flyer growth companies. And I think what's happened is all of those factors I just mentioned have really made investors look hard at what they're buying. Again, stock ownership, you're buying a piece of a company, either the success or the failure of that company. Also translate to the earnings, the growing earnings or the falling earnings. Earnings are the big key here. So a year ago, people were paying 20, 50, 100 times revenue, 100 times sales of these companies that were not actually earning any money on their bottom line. And I think we've taken all of those factors I just mentioned, and they're looking at the reality of what these companies, what that means for these companies and the environment that they're in. And I think there's been a paradigm shift in what the groups of investors are willing to pay for these types of companies, which is why, while the market is down 15 or 20%, which is painful, you've also seen dozens of companies that are down 50, 70, 80%. These are the companies that, while they may have growing revenues, are still losing money. Again, paradigm shift here. Investors are not willing to pay crazy valuations. That's really the bottom line. They're focused more on wide moat, established companies, great leadership teams, companies that have earnings, that have cash flow. That is what investors are focused on right now, and it looks like that's going to be the case for the foreseeable future. Now, putting this in perspective for us as investors, I want to go to basics here. Two big things: risk tolerance and time horizon. What is your risk tolerance? Are you watching the market? Are you looking at this every hour of every day? Are you opening up are you logging in and looking at the account balance, 10, 20 times a day? I would say your risk tolerance is a little bit lower or a lot lower than other people. If you're kind of going about your daily life and you realize the market's doing what it's doing, sure, it's unfortunate, but you understand that these things happen, these periods happen, you're just kind of riding it out. I would say those type of investors have what's called a higher risk tolerance. But really take some steps here. Look at your reaction, emotional reaction to what's going on. Assess your risk tolerance. Is your time horizon long enough to ride this out? If you're looking out 3 or more years for this investing type of account, I would say you have a long-term time horizon, and you can take opportunities like this to, again, focus on your asset allocation and start to focus on maybe a buy list of companies that fit that criteria and look at places to potentially add there. If you're using this money for a down payment on a house over the next 6, 12, 18 months, that's a much different type of investor. And there you've got to be, in much more higher quality, shorter duration type of assets, fixed income, looking at the fixed income there, stuff like that. So where are you on the risk tolerance spectrum and where are you on the time horizon spectrum? Those two key factors, those basic core factors should kind of tell you how you should be reacting to what's going on now. And again, if your time horizon is long enough, try to do your best to take the emotion and the panic and the anxiety out of the day-to-day volatility. Again, get those buy lists ready. Look at some places you may have some excess savings and maybe start putting some more money to work. If you haven't maxed out IRAs, now's a good time to start increasing those contribution levels. If you have a 401k salary deferral and you're not maxing out your annual contributions, maybe increase your salary deferral by $100, $300 every pay period right now. Now that the market is down, start putting a little bit more of your contribution levels to work here. And finally, let's go into the financial advisory tip and trick. We're going to focus on the Roth conversion. So basics, what is that? So we're converting a traditional IRA into a Roth IRA. And why are we doing this? It's for tax purposes, as you'll see in 1 second. But Steve, why does that matter right now? Sure, I know what a Roth conversion is. Why are you telling me this right now? Why are we focused on it here? Well, let's pull up an example here and you'll see exactly what I'm talking about. Let's say you have a $100,000 IRA and you do the Roth conversion. Let's also assume you're in a 25% tax bracket. So you're going to pay 25% on your $100,000 conversion. Easy math here. That's $25,000 of a tax liability you have on the conversion. Now, the market's down pretty significantly. Your IRA has taken a hit. It's gone from $100,000 down to $80,000. Well, now you're going to convert the $80,000, the lower balance IRA, into the Roth IRA. You're going to pay taxes on the 80. Now let's go back again and do the easy math. You're going to pay the same 25% tax rate, but on the $80,000. So your tax liability is now $20,000. So you just saved yourself $20,000 in taxes for this conversion because the market is down and because the account balance is down. So we've turned the lemons into lemonade. You've taken this downdraft in the market and you've saved yourself in taxes. And guess what? Big picture, why are we even doing this? Well, just like we're saving taxes now because of the downturn in the market, we're going to have tax-free withdrawals on the Roth IRA down in retirement. So the regular IRA, when you take money out in retirement, it gets taxed as ordinary income, whether you take out $10,000 or $100,000. The Roth IRA in retirement is all of it is tax-free. So you're going to take a little bit of a financial pain right now by paying the taxes, but in retirement, as that money grows and grows and grows, you pay zero tax on your Roth IRA withdrawals. Awesome, awesome. And one other positive here on the Roth IRA. So there is no RMD, required minimum distribution, with the Roth IRA. The IRS cannot tell you when and how much to take out of the Roth, whereas they can do that after a certain age with the traditional IRA. So you have a couple of different benefits. Again, the biggest thing here is tax-free withdrawals. Say it again, tax-free withdrawals. So there you have it. We've just created our lemonade stand. We've turned lemons into that delicious lemonade, and we are converting to a Roth IRA. Okay, that is it. Thanks for the time. Just wanted to leave you again with a quick note here. One thing that I like to focus on with my clients, the phrase that I always focus on here, save and invest. If you are in this and if you have that long-term time horizon, like I talked about, focus on saving and investing. Saving and investing. Repeat, save and invest. I was listening to a great podcast and they were talking about savings rate is as important or more important than the stocks that you buy or the return that you get in any given year. Your savings rate is the most important thing if you are investing for that long-term time horizon. So say it with me again, save and invest, save and invest. I know it feels very counterintuitive right now with the downside and the anxiety we're experiencing, but focus on those three words, repeat, repeat. Say it one more time, save and invest. Okay, thank you all again for the time, and we'll see you on the next video.